What's up everybody, Michael Elefante here. The real estate market has gone bananas over the past few years, inflation is skyrocketing, and interest rates continue to rise. So, is Airbnb still a profitable investment? And if you're a new investor looking to get started, should you even bother? The short answer is, it depends. Towards the end of this video, I'm going to reveal some of the top markets or types of markets that I am personally looking to invest in at this current time. Now, if you appreciate this content and the transparency that I provide, please do me a favor and hit the like button and definitely subscribe for all future free content as it pertains to real estate, financial freedom, and Airbnb. Short-term rentals can still be an extremely lucrative investment, but I say that with a grain of salt. Because if you set up an average rental, even in one of the best markets in the world, you may end up being cash flow negative some or even all months. You also have to consider the fact that real estate is far more expensive today than it was just 2 years ago, and interest rates are also far higher. Just for example, let me break this down for you. A $500,000 property at a 3.5% interest rate a couple years ago with a 20% down payment and a 30-year mortgage would give you a monthly principal and interest payment of $1,796 per month. Today, that same house would likely sell for around $700,000 and you'd have an interest rate closer to 7%. So your monthly principal and interest would now be $3,725. That's a $40,000 higher down payment and an increase of $1,929 of monthly principal and interest, which adds up to a whopping $23,148 per year. That's $23,000 less in cash flow. This, along with the amount of money out of pocket required for the new down payment, both combined reduce the overall cash-on-cash return of our investment. For those that aren't familiar with cash-on-cash return, it is simply the total annual cash flow expected divided by the total amount of money needed to invest to get that investment up and running. With all that being said, don't let this scare you out of investing in a short-term rental. The good news is that the profit margins and the cash-on-cash return potential is so high with short-term rentals compared to any other form of investment in real estate. There is honestly just plenty of wiggle room to still achieve high cash flow and a high return on your investment. Here are some tips to help you be successful on Airbnb. When setting up your next short-term rental, it is crucial to leverage data from sites such as AirDNA. By the way, I have a few 20% off coupon codes left for AirDNA. If you're interested, go to the link in the description below this video and click on that link and use code MELEFANTE20. On AirDNA, I recommend going to the top property section for your specific market and filter the number of bedrooms that you think you want to invest in for your specific rental. First, look on the map and notice where some of the top properties are clustered within that market. This will help you set up a search criteria with your realtor, maybe a specific zip code. Location is crucial. Travelers are willing to pay more for places in the specific location within that market than other locations within that market. Secondly, start to click through some of the top properties, and you can actually click and drill into the Airbnb or Vrbo listings themselves. What amenities do they have in common? What themes do you notice they have in common? This will help start to craft the vision of what you want for your overall design, furniture, and amenities that you want in your property. Do not overlook design, furniture, and amenities. You will absolutely get a direct ROI from this. We as humans have attention spans that do not last more than just a few short seconds thanks to the internet and social media. If you don't have an eye-catching listing with amazing photos, the amount of clicks or impressions you get on your listing will suffer, and the search ranking result in Airbnb and Vrbo will also be much lower. The less impressions, clicks, and conversions you get, the less opportunities you have on Airbnb, and ultimately you will suffer long term. And as competition ramps up in many markets, saturation can occur, which just stresses the importance of standing out even more. And here's why. During the busy season, everyone will get booked, but you will get booked at a premium rate. During the slower months when demand goes down, everyone's prices will go down, and you will get booked while others probably won't get booked, even if it's a lower daily rate than you're used to or hoping for. So the top 25 to 50% of performing properties in any market long term will capture demand, while the bottom 50% will suffer and participate in a race to the bottom of daily rate just to capture some bookings. And personally, I never want to compete solely on price. I want to compete on selling on the experience that the guests get with my property versus the one next door. Now, for those that stuck around, I did tell you I would mention some of the top criteria I use when selecting markets, and here they are. There are two types of markets generally speaking. Vacation rentals, think beaches, mountains, lakes, and urban markets, more short-term rental markets. For the urban areas, I want to invest in locations that have heavy tourism and a growing population. I recommend going online, doing some basic market research for fastest growing cities by population in America. A growing population typically brings in a lot of new investment and businesses. There are more people that are moving to a city that also brings demand for housing. This will help keep pressure on the supply in a market and hopefully provide a fruitful long-term investment from you from not just a cash flow, but an appreciation standpoint. Also, see if you can find tourism numbers online. Check data on AirDNA for occupancy and daily rate trends over the past several years. For vacation markets, you want to invest in a location that has steady or growing tourism. In markets where there are lakes or beaches, you can only build so many properties that are waterfront. These homes tend to hold value better than others long-term and will also have higher rental demand. However, keep in mind that many of the traditional vacation destinations are not growing in population as fast as some of the urban areas are. So unless the daily rates and occupancy are trending upwards as well, the more expensive the real estate prices are, it can make it difficult to find a property that cash flows really well within the first couple of years. I personally look at markets that are less seasonal or traditionally less seasonal, meaning demand doesn't spike drastically during a few months of the year and then tank during a slow season. Each market has busier months and slower months, but at the end of the day, I still want to be cash flowing decently even in the slower months regardless of the time of year. And although you can still make a killing in really seasonal markets, personally, I try to avoid them because if you don't have a really good busy season or if there's something else that affects rental demand in that specific market, you're going to struggle for the entire year. So I definitely recommend looking at the seasonality tab on AirDNA for more information on your specific market. I will leave you with this. Always rely on a sound investment analysis. Make sure you strip the emotion out of it and rely on the numbers to ensure your conservative forecast still satisfies your investment and ROI criteria. I would much rather be surprised by more cash flow than less cash flow. And if you need help along the way, I highly recommend checking out Airbnb Investor Academy and some of my other resources, which I will drop in the description below this video. If you did find value here today and some of the transparency and tips that I provide, please don't forget to hit the like button and make sure to subscribe if you want access to more future content like this in the future. Appreciate you watching.